We're starting off with a story that's been making waves in the tech industry. NVIDIA Corporation, or NVDA, has been a favorite among investors, but its share price performance in 2026 has been less than stellar. Despite this, Jim Cramer, the well-known CNBC TV host, has stuck by the company, recommending that investors own its shares. But what's behind NVDA's struggles? Some point to macroeconomic factors, such as the recent payroll report, which showed a higher-than-expected jump in non-farm payrolls. This led to a 6.2% drop in NVDA's shares on June 5th. Others suggest that the company's troubles may be related to the performance of other AI giants, such as OpenAI, which recently missed its revenue estimates. However, Cramer remains bullish on NVDA, citing its potential for growth and its position as a leader in the field of accelerated computing. He even went so far as to predict that the company would have a great first quarter and that its price-to-earnings multiple would shrink once the numbers were released. But is Cramer's optimism justified? We took a closer look at the numbers and found that while NVDA's shares have been underperforming, the company's fundamentals remain strong. Its revenue and earnings growth are still impressive, and its position in the market remains solid. On the other hand, some investors may be getting nervous about the lack of insider buying activity at NVDA. According to recent reports, insiders have sold a net of over $15 billion worth of shares in the company over the past 3 years, with very little buying activity to offset these sales. This could be a sign that insiders are losing confidence in the company's prospects. We also looked at what other experts are saying about NVDA. Some are warning that the company may be due for a correction, given its high valuation and the potential for a bubble-bursting event in the tech industry. Others, however, see NVDA as a long-term winner with a strong track record of innovation and growth. So what is the takeaway from all this? While NVDA's share price performance may be volatile, the company's fundamentals remain strong. However, investors should always do their own research and consider multiple perspectives before making any investment decisions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into a fascinating tale of diverging analyst views surrounding AngloGold Ashanti plc, a leading global gold mining company. On one hand, Freedom Broker has initiated coverage with a buy rating and a $114 price target, highlighting the company's recent portfolio transformation and improved balance sheet. This optimistic outlook suggests that AngloGold is positioned for enhanced operational and financial performance. On the other hand, Roth Capital analyst Joe Riagor has reiterated a buy rating but lowered the price target to $110 from $121, citing the significant impact of Guinea's ban on unrefined gold exports and the decline in gold prices. This more cautious approach underscores the potential risks and challenges facing the company. It's essential to consider both perspectives and acknowledge that investing in AngloGold Ashanti plc comes with its own set of risks and uncertainties. The company's operations are subject to various market and regulatory shifts, which can significantly affect its performance. As investors, it's crucial to weigh these factors carefully and make informed decisions based on thorough research and analysis. As we navigate the complex world of investments, it's vital to remain aware of the potential pitfalls and opportunities. AngloGold Ashanti plc's story serves as a reminder that even established companies can face unexpected challenges and that diversifying your portfolio is key to mitigating risk. Welcome back to the Riskwiser Zone. As we wrap up today's show, I'd like to bring to your attention an interesting development in the world of artificial intelligence. A consortium of major Canadian companies, including Scotiabank and TELUS, has come together to form a unique partnership aimed at controlling and governing AI applications. This first-of-its-kind model allows member companies to share resources and expertise to develop a platform that can manage and scale AI-generated data. The project, known as the Agenda Control Plane, is already being used to handle over 2 trillion pieces of AI-generated data each month. The consortium's goal is to provide a solution to common AI-related problems that all companies face, such as governance and operational management. By working together, these companies hope to strengthen their respective industries and protect Canadian interests. It's worth noting that this partnership is not without precedent. A similar consortium, SimCorp Inc., was formed in 1996 by Canada's biggest banks to prevent duplication of efforts in processing checks. As we consider the implications of this new partnership, it's essential to weigh the potential benefits against potential risks. On one hand, collaboration and knowledge sharing can lead to significant advancements in AI technology. On the other hand, there may be concerns about data privacy, security, and the concentration of power among a few major players. Ultimately, the success of this consortium will depend on its ability to balance cooperation with competition, innovation with regulation, and growth with responsibility. As investors, it's crucial to stay informed and adapt to the evolving landscape of AI and its applications. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, keep your finances in check.